Hello guys, welcome to my next video, and today we're going to talk about 10 simple rules for investment success, which is very important, guys. Okay, so we're diving into the 10 simple rules for investment success, like I said, straight from the legendary John Bogle. Okay, who is this gentleman? He is the founder of Vanguard and the pioneer of index funds investing. So all those ETFs which you know from Vanguard, VUG, VGT, VUO, and etc. He is the guy who invented all of them. So if you want to build long-term wealth and retire comfortably, these rules are a must-know, okay? Pay attention. So Bogle's principles have stood the test of time, that's for sure, helping millions of investors grow their money without stress, without complexity, and without falling into common traps. Okay, we're going to discuss all the rules one by one. Okay, we'll start with rule number 1. And the rule number 1 is remember reversion to the mean. Okay, so what does it mean? So he's saying basically what goes up must come down. So one of the biggest mistakes investors make is chasing hot stocks. Okay, we're talking about Nvidia, Tesla, and all that stuff. I'm not saying that it's the wrong way to do it. I'm just saying that it's too risky to do it. Okay, so just because something performed well recently doesn't mean it will keep going up forever, which is very important again. Think about it like this. If a stock or a fund soars way above average, eventually it will come back down to normal levels, okay? It's called reversion to the mean, and it happens all the time in investing. So I think rule number 1 is very important and is the most important one. So because markets move in cycles, what's hot today cools off tomorrow. Okay, so lesson, what kind of lesson do we get? Don't chase past performance. A fund that crushed it last year won't necessarily perform well next year. Okay, that's what it means. Stick to a balanced strategy and don't let short-term performance fool you. Okay, so we're gonna discuss, we're gonna go to rule number 2. And time is your friend, impulse is your enemy, okay? So the earlier you invest, the better. Albert Einstein once called compound interest the 8th wonder of the world. And he was absolutely right, okay? So the longer you invest in the stock market, the more your money grows exponentially. For example, let's say you invest $10,000 at age 20 and earn, let's say, 8% per year, which is very reasonable. S&P 500 basically gives you that return. So by the age 60, your investment would be worth over $217,000 if you invested just $10,000 without putting any penny after that. But if you wait until age 40 to invest the same sum, $10,000, it only grows to $46,000, so it's a big difference. So starting early is the biggest advantage you can give yourself. But there is a danger, impulse. Many investors panic when the market crashes, and that's one of the biggest mistakes you can ever make. They sell at the worst time. So Bogle advice is ignore the noise. Stay calm, let compounding do its magic, okay? If you're patient and stay invested, for the long term, the market will reward you no matter what, because you cannot stop the progress, okay? No matter what, the dollar is gonna depreciate over time, and everything is getting better and better. So you can't stop the progress, okay? So rule number 3, buy right and hold tight. What does it mean? So most investors don't fail because they pick bad investments. They fail because they can't sit still, okay? So they see stocks go up and they chase them. They see stock go down, and they panic and sell. That's, again, one of the biggest mistakes you can ever make. So pick solid investments and hold them for life. Again, a good example, it's going to be S&P 500. So Bogle believed in buying low-cost index funds. Like I said, you can do IVV, VUO, doesn't matter, SPY, and holding them forever. The stock market will have bad years, but over time it always trends upwards, okay? You have to understand that. So stay patient and you will win. Rule number 4, okay? Have realistic expectations. Don't think you're gonna get crazy and super rich tomorrow, okay? It takes time. You have to understand that as well. So a lot of people think the investing is a shortcut to quick wealth. They see stories of people making huge money fast, especially right now when the crypto is booming. So people want to get to buy meme coin, it doesn't matter what kind, and then wake up tomorrow and be super rich. It doesn't work that way, okay? So I have to be patient. Short-term speculation is gambling. You have to understand that. So Bogle once compared investing to a bagel and a donut is a long-term investing. So basically, the bagel is a long-term investing and the donut is a short-term investing. That was his comparison, okay? Because bagel is a solid, nutritious, and good for you, and donut something sweet which is very bad for you, okay? So lesson, which we're gonna get from his example: skip the sugary thrill of the day trading and go more nutritious power and long-term investing, okay? Rule number 5, okay, we'll go, and it sounds, forget the needle, buy the haystack, okay? So own the entire market. Don't go and don't chase a particular stocks. Again, if you want to take more risk, go ahead, and that's extremely risky, okay? So again, instead of doing that, buy the whole market. So finding the next great stock is like finding a needle in a haystack, okay? So just buy the whole haystack. That's what he's saying. That actually what index funds do, okay? Again, the best example is going to be VOO. When you buy the S&P 500, the whole market, the biggest 500 companies in the United States. Rule number 6, minimize the croupier stake. So imagine going to a casino and giving the dealer 2% of your money every time you play. That's what the high fee mutual fund do to you. So Bogle's research showed that fees and expenses can eat up over 60% of your potential returns over time, over lifetime, which is crazy, okay? That's why you have to pick ETF with extremely low cost index funds. Again, VOO, I think its expense ratio is about 0.03%, which is like if you invest $10,000, you only pay $30, which is nothing. So let's go to the next rule. There is no escaping risk. Okay, so every investment has risk. That's what he's saying. But some risks are worse than others. A lot of people avoid stocks because they fear losing money. Instead, they keep their money in cash or low-yield bonds. But here's the problem. Inflation silently destroys your wealth. Okay, nobody thinks about inflation. The inflation is nowadays about 5% at least. So when you keep the money in cash, you lose all that money, okay? So at least when you invest into the whole entire market, you have a chance to beat the inflation and be ahead of the inflation, okay? So at least to make, I would say, realistically 3-4% clean. Okay, so rule number 8, don't fight the last war. So what does it mean? So what worked in the past won't necessarily work in the future. So investors always look in the rearview mirror. So when inflation was high, he was talking about 1970s, which is crazy. He's talking about 1970, 1990, and 2000, about when the real estate boomed, when the stock market soared. By the time everyone catches on and the opportunity is already gone. So people are trying to do the same thing, but it's too late, okay? So instead of chasing all those streams. Just keep investing. Always be buying, like I always said. Be patient and keep buying. Okay. So rule number 9: the hedgehog beats the fox. Okay. The simple investor wins. The complex investor loses. That's what he's saying. So a hedgehog knows one big thing. He's saying keep it simple and keep it the same way. Let's say if you invest certain amount, just keep investing certain amount. Don't try to pick the stocks and go and try to find a shortcut and be ahead and like be the smartest person ever. No, again, long term it doesn't work that way. So just buy index funds, hold for life, and ignore the noise. Okay, the Wall Street's foxes try to outsmart the market, like he's saying in this example. Again, just be very simple, be patient, and always be buying. Rule number 10: stay the course. Again, great rule. Make a plan, stick to it, and no matter what happens. Okay, like again, if you decided to invest into S&P 500, it doesn't matter. It's gonna be crash, it's gonna be a huge rally. It doesn't matter. Just keep investing, keep investing. So like he's saying here, ignore the market swings, ignore economic forecasts, and ignore financial news hype. Okay, it's all noise. And again, guys, that was the 10 rules, which is the most important rules you can ever imagine. Okay, so again, if you enjoyed this video, please like, subscribe, and drop a comment below. What do you think about those 10 rules? As me, like again, if you're talking about me, I just keep buying particular index funds. Again, I'm not gonna advertise them, but I'm pretty much talk about those funds all the time. There is nothing complicated. Again, it's gonna be VOO, which is S&P 500, VUG, okay, and VGT. That's the 3 index funds I'm keep investing. It's not financial advice, but again, that's what I think for me, again, long term, it's going to be the best way to do. And again, guys, if you find this information useful for you guys, please like the video and please subscribe. Okay, we'll see you in the next video. Thank you so much, guys. Bye.